We're living in a country where only 7% of the population can afford to retire. We need to be aware that not too far into the future, the South African government intends to amend retirement regulations. Now, many argue this will ultimately give government the go-ahead to use pension fund resources to bail out struggling state-owned enterprises. Questions arise as to whether the move would be lawful and whether pension fund members are fully aware of how this will impact their future. That issue will take up much of our discussion today, but we'll also look at the best retirement models for you to consider as an investor and whether those advising you should be held accountable in regard to the long-term performance of your pension fund. If you have any questions you'd like to ask our panelists, please post them in the live chat. We'll get to them a little bit later on in our session. And if you're joining the conversation on Twitter, please use the hashtag BDdialogues_ASI in your posts. Let me start by welcoming Chief Executive Officer at ASI, Anthony Govender, who's with me in studio. I'll soon introduce you to our panelists joining us remotely today. Anthony, I'm going to kick off the discussion with you at this point, though. And I'm going to ask you to start off by just giving us the lay of the land, right? We know there's a really small taxpayer base. You've got about 3 million people paying 95% of taxes in the country, which seems wholly unsustainable. Massive dent in the tax base due to unemployment. Can South Africans in general afford to pay for their retirement?
Well, firstly, good morning, Jan, and thank you for allowing me the platform. The short answer is no. South Africans certainly can't afford to continue paying retirement fund contributions, and the reasoning behind it is a simple one. The average South African household is hugely indebted. Probably the best way to contextualize this is that we're living at a level of debt where we're spending tomorrow's money today. And I think until such time that we can get rid of the perpetual cycle and dependency of debt to actually keep our households running is the only time that we're going to have South Africans contribute more into retirement funds. The challenge that we have, Joanne, is that we have a cash-strapped society at the moment. And the average South African places more value on disposable income rather than preserving for the long term. And I think if we look at the broader sort of economic context, if you look at South Africa, as a household to the nation, it's no different to the average South African household. South Africa as a household to the nation spends roughly 21 cents of every rand that comes into the fiscus on servicing debt. And until we can fix up the debt problem in South Africa is the only time that we're going to get to a point where South Africans can preserve and contribute effectively to a retirement fund and ultimately live financially independently.
So tell me this, what does it mean for the state if people can't pay for their own retirement?
Well, what we're creating, Joanne, is a vicious generational cycle of financial dependency and a perpetual dependency on state. And that's what we need to address as part of the structural reform. And 2 weeks ago, we spoke about social security. The reason why you and I come to work is because of social security. We put in our years of service and employment with the hope and understanding at the point of retiring, we'd have a sufficient nest egg to take care of us in the latter phase of life. Right now, only 7% of South Africans can retire financially independently. In June of this year, looking through some of the reporting that SASSA had done, we had paid 18 million grants spread across about 11.5 million beneficiaries. But these 18 million grants, predominantly to women and children, is funded entirely from state. Now, the question that you and I need to ask ourselves is how many more families can we take care of? As you and I sit in studio today, you're probably not just taking care of your own family, but probably a dozen others through the means of subsidy, through social grants. And if we don't get the financial independence of our society right, ultimately it's going to cost our next generation in a greater tax burden. And that's the reality that you and I as South Africans need to understand, that if we don't preserve, it's ultimately going to cost another generation a hell of a lot more in tax.
Explain this to me. Where are most of the country's pension funds being invested as we speak?
Jan, fortunately, and I know there's a lot of discomfort around prescribed assets, so let me allay some of the fears and concerns for our viewers today and say that the pension funds industry is one of the best regulated industries in the world. Our pension funds law is absolutely fantastic, and certainly the supporting regulations. Pension funds are compelled in an investment strategy and guided by Regulation 28 specifically in terms of how they invest their money. So, as a case in point in South Africa, roughly 75% of our pension funds are invested in equities. In fact, part of Regulation 28, it prescribes that 60% of our pension funds are invested in local assets. So a major part of what you and I contribute to in pension funds are already hugely invested in South Africa. The concern that I have, Joanne, is that there isn't sufficient diversity, because if we look at the JSE, and I must just point out that South Africa remains an incredibly attractive investment destination for global investors. We're one of the best performing stock exchanges, the JSE specifically. It's one of the best performing stock exchanges in the world. Arguably amongst the best, the top 5. Now, if we look at the JSE, 60% of the JSE is made up of roughly 10 large companies, the likes of Naspers.
Right.
You'd recall the Steinhoff saga, and with the failure of Steinhoff, it cost pension fund members billions of rands. We need to ask ourselves, how do we widen that net in terms of investment? Because certainly investing the bulk of our pension funds in a limited base of companies, because those are the only companies that are stable and sustainable and feasible in the long term, we need to ask ourselves, how do we widen that net? And certainly this is a conversation in terms of broader transformation that's needed in the country, and inviting more businesses, more specifically South African businesses and black business, into the mainstream economy, so that you and I as pension fund members have a wider choice.
All right, Anthony, so I think you've opened the discussion up quite well for us, and let's continue it by bringing the rest of the panel into our conversation at this point. Let me welcome Managing Executive, Corporate Distribution at Sunlams, Viresh Maraj. Independent Scenario Planner, Clems is with us, as is Head of Advice at Old Mutual Corporate Consultants, Andrew Davison. A pleasure to have all of you gentlemen. Thank you so much for being with us today. Andrew, let me kick it off with you, and this is picking up on what Anthony had to say to us a moment ago, this concern that South Africa's cohort of financial advisors doesn't remotely represent the diversity of South Africa's population. Is that an issue that ought to be urgently addressed?
Thanks, Joanne, and thanks for having me. So yes, I mean, I think that is something that needs to be addressed. I think what is important, obviously, is that people do deal with people that they feel comfortable, especially in financial advice. So we need to make sure that the advisors that are available for the man in the street to deal with are people that they can identify with, that they feel have their interests at heart, that they can build a trust relationship with. And often that is, for people, that is someone who's similar to them, so there's often a situation where people who are getting into retirement don't really like dealing with an advisor in their 20s, because they don't feel that they can identify with their life situation, their challenges. So they would prefer to deal with someone who has a bit more gray hair. So that's just one example. So absolutely, we need to make sure that the financial advisors are a wide range of different types of people that are going to be able to actually identify and connect with clients. And for me, that trust is so important. You need to be able to trust your financial advisor, and that does take a bit of time, but first of all, you need to find someone who you're comfortable with. And then obviously over time, you build that trust relationship. So my point is that we need people that represent our population, because those are the people that are the ones seeking the advice.
I mean, you make a really good point there, Andrew, and Viresh, let me pick up on that here. Isn't it inherently problematic, perhaps, that most asset managers in the country who decide where to invest pension funds are white, perhaps they're male as well, or is that irrelevant so long as they're skilled at what they do?
Well, first off, good morning, Joanne and Anthony, and to the rest of the panel, and to all the viewers here today. It's a privilege to spend the morning with you. Given the responsibility placed on asset managers and the scaled impact that their decisions have on the quality of life of millions of South Africans, You want the best, most capable and competent professionals available managing our monies. Now, I must emphasize that race, including being white, is not a proxy for any of these characteristics. The reality, though, is that the demographics of the asset management industry, whether in staff complement or ownership, do not resemble the demographics of the country for the historic reasons that we're all well aware of. Much good work is being done by various organizations, including, for instance, APSA, Saba, ASA, and the CFA Society, to address many of these imbalances and to provide opportunities to the current cohort of Black asset managers, as well as to develop the next generation of professionals in this industry. And it's not just for the sake of transformation, which is a good thing, but also to improve outcomes. Because on investment committees, and it speaks to a point that Andrew's touched on earlier, you want diversity of experience, of thought, of different perspectives in order to analyze decisions as well as situations from various lenses in order to arrive at robust decisions. A mechanism to achieve this diversity is through transformation across age, gender, as well as race categories, due to the implicit lived experiences of these different categories of people that can be brought to the table. Now, this is where transformation, and more importantly, inclusivity, can have a marked impact on the investment processes of asset managers and ultimately on the sustainable investment returns delivered to fund members.
So, Anthony, whose job is it to address this transformation issue and perhaps begin the acceleration that Viresh is talking about?
Jan, I'd like to just touch on what Andrew and Viresh has spoken about, which is, firstly, what is the currency that we sell as an industry? The currency we sell as an industry is trust. It's not investment returns. It's not about how much of money you're going to place in the fund. It's not about your income. It's about the trust between you as the client and me as the advisor or the insurance partner. And the only way of building the trust bank in South Africa is to get the industry, the face of our industry needs to represent the face of the South African consumer or the South African client. And so the disconnect that we have in industry at the moment is that the face of industry in the financial services industry and the face that we have of South Africa is fundamentally different. We need to transform the industry, and I think it's an obligation to speak more directly to your question. It's a responsibility in all stakeholders. Yes, government has a part to play in policy, policy drafting and regulation and enforcement of that. But I think as an industry, we need a greater sense of will and leadership will within industry to drive that transformation. We need to invite more Black financial advisors into the industry. We need to train and develop them. We need more Black asset managers, part of the country. Just as a statistic, Black asset managers barely manage 10% of the entire pensions industry. And if we look at the assets available in the pensions industry, at face value, the industry looks great because it's roughly 4.2 trillion rand that's available in the market. And you would think that, well, this is a really well-run and diverse industry, but that's just on paper. The unfortunate reality in practice, we have too little participation from, firstly, Black asset managers, but more importantly, the face of our industry needs to change. Certainly, if we are going to engage with the gogo in the township, and if we're going to have an impact to a rural household, we need a financial advisor that firstly resembles the demographic, the language preference, and more importantly, the cultural requirements in order to build that relationship and build that currency of trust.
So that is such an interesting thing, Clem, and I'm sure you can comment on this particular aspect which Anthony has explored for us right now, and that is the issue of the kind of disconnect that can occur between the people who are actually selling these products or marketing them and going into people's homes, and those who are buying from them, who perhaps don't at all identify with the person who's sitting across from them selling the products. What would it mean in more practical terms if there were more Black asset managers in the country?
I think that the panel have made it very clear that we've got to develop a product which is suitable for people living in townships, and that product may be very different to what we have at the moment. But I'd like to get on to a more general point as a scenario planner, and I do quite a lot of international work. The diversity flag, which is talked about by many of our clients now, it's the flag that is probably changing so many different games in the world. It was probably responsible for Biden beating Trump. And so it is now everywhere. It's being faced by investment management companies in New York. It's also being faced in London. And now we've got to face it fair and square here. And that means not only finding out what the financial needs are of the majority of the South African population, it does mean that we've got to educate and train a very different group of people. And that goes back to, I think, the business schools. It goes back to the actual training programs. And I want to see all the major players in South Africa, including the two represented on our panel, getting together and saying, what is the viable way forward to handle this diversity flag? Because it's not going away, it's beyond our control. And it would be much better if we can come up with a sensible plan rather than have anything imposed on us by the government. So this is the moment to grab.
So Andrew, let's bring you back in here, and perhaps we should start moving towards the prescribed assets conversation, because I think that is one of the ways in which government is going to potentially intervene in the next few years. Who ultimately decides where pension funds are invested right now, Andrew?
So, as Anthony said, there are certain restrictions in the form of Regulation 28. So there are some requirements from a legislation point of view, but in general, there's quite a lot of freedom for the trustees of the pension fund or provident fund to make the investment decisions. And obviously, they aren't always knowledgeable and expert enough on investment matters, so they will often have an advisor, whether that might be an asset consultant or some other, maybe an employee benefits consultant, but certainly some advisors that would assist them. But in general, the decisions are really held by the trustees of those funds, and they would have then an asset consultant, as I said, and then ultimately, obviously, the money gets invested with asset managers. So they have the ultimate decision-making in terms of things like asset allocation, things like the actual instruments or the shares or the bonds that are being selected. So there are actually quite a few layers, but the overall strategy is set by the trustees of the fund.
And Viresh, as it stands, we know that government can't prescribe to trustees where they should invest their money, but it is looking at amending legislation to prescribe to be able to change that. Are you at Sunlam in favour of that?
Joanne, just perhaps an issue of clarification. All indications, including statements from Treasury itself, are that prescription is off the table. In fact, government is well aware of the necessity of avoiding the implementation of damaging economic policies, given that in its letter of intent to the IMF relating to the loan delivered earlier this year, where it stated that it won't implement policies detrimental to the maintenance of the balance of payments. The introduction of prescribed assets, which is the fear that we're discussing here today, would certainly introduce substantial market distortions, putting that balance of payments at risk. Distortions such as, for instance, effectively crowding out the private sector from the capital allocation decision of retirement funds, potentially allocating funds to inefficient sources of returns, amongst various other issues which we've lived through in the past and many other governments and countries around the world have grappled with historically. In addition, and I think this is quite encouraging to our viewers, there has been no mention of prescribed assets and the economic recovery plans tabled by the various stakeholders at NEDLAC itself quite recently. Now, to your question around Sunlam's view, Sunlam is a member of ASISA, and the association has categorically opposed the introduction of prescribed assets and has been quite transparent, objective, and clear in the reasons behind this objection. Now, the status quo, as we perceive it, is for government and industry to create an environment that is conducive to investment rather than compelling such investment. So a pull rather than a push.
Well, Andrew, how would OMCC feel about this prospect? Clearly, Sunlam is anti the idea of prescribed assets.
Yeah, thanks, Joanne. So I think what's important is that I haven't found anybody in the industry who is opposed to pension fund assets being used for developmental and impact type of investments. I think there we are aligned that there is a positive benefit that the stock of savings in the retirement industry can be used for the good of South Africa. The problem with prescribed assets is that is the wrong way to do it, because as Baresh has said, no matter what asset it is, as soon as you prescribe it, you distort the supply and demand dynamics, and that unfortunately distorts the pricing of those assets. And what that really means is that because you're now a forced buyer, you have to accept less favorable investment terms for those assets. And because the sellers know that, they know you're a forced buyer. So that is going to diminish the returns on those assets, even if they start out as fantastic investments. As soon as you put the label prescribed on them, they become a less attractive asset, no matter what they are. So that is really our concern, is that we think that there's a lot that can be done, and impact investing, there's a lot of talk, there's a lot of action happening in the impact space, but prescribed assets is a way to do it that will cause more damage than good in our view.
Clem, we know that pension funds represent the years of hard work, sacrifices on the part of people who, over a period of decades, who are looking forward to a decent retirement at the very least. Should government actually be able to dictate where that money is invested, particularly given what Varesh and Andrew have told us about distortion that may occur potentially?
Obviously, I don't think we should have prescription. I think Varesh explained very well that there isn't that spirit either on the government side and certainly not on the industry side. And Andrew, I think, made the absolutely critical point that we're all passionate about putting money into developing South Africa. And yes, there well may be infrastructural and development projects which the pension industry can put that 4 trillion into. But obviously they're going to have to be properly managed, and they're going to have to be, the people chosen must know the game that particular development project is in. We've got to go back to basics. So I think there's a genuine desire to do that, and that is very much a voluntary thing. But there is one other area I'd like to raise, which is private equity. Mm-hmm. My view is that work has changed from the last century, and that the days when big companies created hundreds of thousands of jobs are over. And if you want to make a huge dent on our abysmal unemployment rate at the moment, it's going to be by new enterprise. It's going to be by creating an entrepreneurial revolution. So if there's one area I'd like to see being discussed, it's the area of private equity, which I know is sort of limited to around 10%. That figure should maybe be raised, because it is the most crucial area post the pandemic to focus on in order to create an economic revolution in South Africa. You want to create millions of jobs, we've got to create millions of new businesses. So yes, I don't think that will come out of prescription. It's going to come because there's going to be conversations between the major players and government on how we can really set up a proper entrepreneurial fund.
Clem, what you're talking about right now is fascinating, and Anthony, I want you to expand on that for us in a little bit more in just a moment. But let me go back to this idea around prescribed assets first of all, and just get some more detail on that. I mean, some may argue this is an old apartheid law dating back from 1956. It's not appropriate to democratic dispensation. How serious is government about prescribed assets, to the best of your knowledge?
Jan, I think if we consider just some part of the challenges that face the South African government, and we spoke about social security reform in respect of national health, and the major constraint is funding the cost of public health infrastructure and the upgrades needed in the country. We have a similar challenge in the general infrastructure development within South Africa. Our fiscus has diminished in size. The first 2 quarters of this year, we found a few $100 billion diminished in tax revenues as a result of COVID-19. And I think the loss of 10 years of economic growth because of maladministration and corruption has really cost South Africans dearly. We don't have many other options in terms of where we can actually get resources and funding from. And so the notion of using the pension funds, the capital liquidity of the pension funds industry to bankroll some part of the infrastructure development that will lead to job creation and lead to sustainable development and provide the economic stimulus that we need to the country, I think it's a great idea. And certainly, I'd like to provide more of a contrarian view to Andrew and Viresh. I believe prescribed assets could work, provided that, and there's a big proviso to this. The governance framework needs to be sound, and the prescription needs to be on feasible and sustainable businesses. And perhaps it doesn't need to be state-owned enterprises. Perhaps it needs to be sustainable and profitable black business in the country. So Clem talks about creating 1 million more businesses so we can create 20 million more jobs. Now, wouldn't it be a great idea for us to invest in black businesses that are sustainable, that are feasible, and get more of these emerging businesses into the mainstream economy? Prescribed assets, if we just simply look at the history of it, introduced in 1956 by the apartheid government, it ran until the late 80s. The performance of those investments were dismal, to say the least. And I've got some stats here. In the 60s, it produced a 1.8% return relative to the market return, which was roughly about 11.3%. In the 70s, it produced a negative return of 3.6%, whereas the nominal return in equities was roughly 24.5%. So the history tells us that it's a bad idea. I think the idea of prescribed assets, specifically in the area of ailing and failing state-owned institutions, and I'm not going to mention any of them by name, but I think we know who they are.
Yeah.
But certainly putting good money into bad investments is not ideal for the pension fund member. What we should be asking ourselves is, how do we use this stockpile of cash that we've got more strategically? And certainly if we're going to, and I want to challenge my partners in industry, we cannot adopt the ways of old to turn the economy around. So if as an industry, we're not prepared to transform the industry, and we go out and say, we need to change things, but we're not prepared to transform as an industry, and we want to adopt conventional wisdom, it's going to fail us even further. We have to change the strategic approach to how we build the economy. And perhaps the answer lies in regulating and government prescribing, but very importantly, a framework that allows trustees and asset managers absolute flexibility within their discretion to pick the best investment classes for these funds to be invested in.
All right, so let's go back to Viresh and Andrew at this point. And gentlemen, I'm really, really interested in what your views are on the possibility of potentially investing in SMMEs, for example, at this point in the economy. I mean, we're told constantly this is the only way we're going to grow the economy at this point. We're going to become highly dependent on the development of SMMEs. Let's start with you, Viresh. Would you feel comfortable, were the boundaries very tightly and strictly drawn, would you be comfortable investing your clients' pension funds in reliable SMMEs, or SMMEs perhaps with a track record?
Perhaps to Anthony's point and to your question there, Joanne, Sunlam is an active investor across private equity as well as various other so-called alternative investment classes, as I would suspect many of the other large financial services providers currently are as well. I mean, as a case in point, in order to help many of these companies to recover from the impact of the lockdown and COVID, Sunlam's created the Legacy range, which specifically looks at addressing or providing funding to high-quality South African companies in different sectors and spaces to help them smooth through the impact of the lockdown, given the high quality of these entities and their potential bright futures. So we genuinely believe that the future of growth lies within SMMEs and play an active role through our private equity plays, as well as various other investment vehicles that we've got available for retirement funds, as well as other types of investors to access and invest in these markets on the back of professional engagement and a deep understanding of the dynamics within this industry.
So, Andrew, I'm not sure if you at Old Mutual are taking much the same approach to the one that Varesh is describing at the moment, but give me a sense of that. Would you feel comfortable? Does your company do this already? Does it invest in small to medium enterprises? And is the average person on the street with that entrepreneurial bent, are they likely to benefit in the long term from your wanting to invest in that kind of business?
Yes, so Joanne, I mean, similar to what Varesh said, Old Mutual is also an investor already in that space. I mean, we do have substantial private equity investments. We do also invest quite significantly in infrastructure and other impact investments, including low-cost housing and schools in rural areas and the like. So we definitely do already invest. SMEs, we do have investment in SMEs, similar to what Varesh is saying. We've actually allocated assets to set aside now for businesses that have been hit hard by COVID and the lockdowns. We try to support some of them that we think have got sustainable long-term futures, that we can actually help them through this crisis. So those are investments that we make as well in certain of our private equity investments. So private equity absolutely is a part of the equation. Obviously, on the listed space, there are also a lot of small businesses there, small cap type of funds. Those are an investment destination already. Obviously, we don't only want to look at the listed space, because that is quite limited to Clem's earlier point. Just one other point on what Clem said earlier, the 10% limit that Reg 28 has is there's a practical problem with 10%. So because private equity is illiquid, if the limit is 10%, there are very few asset managers that are going to allocate 10%. Because if, for example, there's a retrenchment exercise in the fund needs to pay out members, they will not be able to liquidate that 10% necessarily or quickly enough. So now they've reached the 10% limit, and Reg 28 is a problem for them. So what they do is they sit much lower than 10, at 6 maybe, because they give themselves the space. So in other words, if you want 10%, you probably need the limit to be 15. So I think that some of those practical considerations are worth thinking about in terms of the way the limits work.
Anthony, the one thing that comes out of this discussion as well, and listening to what our panelists are saying, is that there must clearly be very strict controls in place if you're going to go this route. You want to know the businesses that you are investing in are going to succeed. The variables cannot just be so arbitrary that it is going to ultimately affect the end user of
Absolutely, Joanna. And I think this is the whole point of giving our viewers a sense of comfort that the pension fund law in South Africa is absolutely robust. We've got great regulations, and certainly, the asset managers, the investment advisors are going to be guided by that regulation. So I think the regulator's done a phenomenal job in providing a layer of protection to the market. It's now a question of how do we operate within that framework. And I think where I have to hold my insurance partners and retirement fund partners accountable is that I don't believe that they're doing enough in terms of adopting more flexibility in the approach. Because if there is that allowance for them to invest into private equity, are we doing enough to find businesses, sustainable businesses that are emerging and investing in them and creating access to capital so that we can enable these businesses to eventually get onto the JSE? I don't believe we're doing enough in that environment. Certainly from a governance framework, I think there's a sound framework. I think the pension funds need to be doing a hell of a lot more in terms of creating access to those businesses.
Clem, what's your take on this challenge that Anthony is throwing out, that companies are simply not necessarily looking in the right places for the businesses we should be growing in this country using pension funds?
I'm totally agree with what Anthony's saying, and I feel very strongly that we need a whole new experience of going around the country, identifying those entrepreneurs in the townships and in rural areas who could make a big difference nationally, and then maybe become international stars. We have so many South Africans who have become international stars. And as I say to people, that in the end, a country is great not because of its politicians, it's great because it produces the entrepreneurs. Look at America, Walt Disney, Bill Gates, Henry Ford, Steve Jobs. Steve Jobs was of Syrian descent. And he's probably made more difference to everybody's life than anybody else. And now, of course, you look at Germany, the two people who've produced the first vaccine are of Turkish descent in Germany. It's fantastic. And that's where we've got to, I think, employ our inventiveness, is to say, how can we take this huge pot of 4 trillion and have some of it invested in what is our essential future as a winning nation.
So let's get to one of the more perhaps terrifying prospects for pension fund investors. I mean, I think one of their biggest fears, Viresh, is that government will insist people's pensions are invested in state-owned enterprises if they prescribe assets. And we know that many of these SOEs are deeply corrupt or neglected. How legitimate is that fear, Viresh?
I've got a question for you, John. How come you keep asking me the hard questions? Look, I think, as has been discussed, the threat of prescription may be overstated, but let's take a hypothetical situation and imagine that it isn't, so that we can address the question you've asked. Just last year, I recall reading that the Auditor General released their report that indicated that the overall audit outcomes of state-owned entities were the worst they'd ever been, and they'd experienced significant regression over the previous 5 or so years. And for those of you who've been following the Zondo Commission just over the last week, you're not going to be filled with a great sense of confidence in how many of the state-owned entities have been run over and above everything that we've already come to understand. So, speaking to points that have been made by the other panelists already, a lot needs to be done to deliver the necessary good governance, efficiencies, and ultimately performance at the state-owned entities. Performance relating to delivery of services to the public, as well as performance in being able to service the debt provided by investors. And to Anthony's point or call or challenge to the industry a bit earlier around potential prescription to deliver outcomes, whether to businesses or to state-owned entities, I think the discussion around Reg 28 is enabling an increase on the limits to provide access to those types of assets. Prescription compels that you have to invest in those. And if we're able to get a virtuous cycle between policy, efficiency of implementation, and delivering outcomes, then by default, state-owned entities and other businesses become more attractive investment vehicles. And to Andrew's point earlier, once you introduce a compulsion to invest, the market distortions do detract from much of the value creation possibility. So effectively, if we're able to provide investment in state-owned entities on a free market basis, where based on investment merits, they make sense, then we're in a position where the public benefits, because if it makes sense from an investment perspective, then it means that they're able to deliver to the public in an efficient manner. And that's where the allocators of capital, such as retirement funds, can put a bit of pressure on government as well as state-owned entities across various measures in order to improve the implementation capacity. Now, the discussion here is around state-owned entities because that's where the fear currently lies. I do want to emphasize that the stakeholders we've already mentioned, the retirement funds, investment consultants, trustees, etc., need to apply themselves also to the private sector. Anthony's mentioned Steinhoff, and that still casts a long shadow. So the good governance and the focus on governance doesn't apply exclusively to state-owned entities. It's got to apply uniformly and robustly across different sectors. To all the viewers, my call to you is to play an active citizenship type role or an active membership role in retirement funds. How many of you watching here today know who your trustees of your retirement fund are? Who is your investment consultant? Where is your fund actually invested? Take an interest and start to play a more active role in engaging these stakeholders so that you can apply pressure and influence from the ground up in order to deliver the types of decisions and outcomes that make most sense.
Some really good advice there, Varesh. Do you want to add to that, Anthony?
I would like to, Jan, and maybe just to stress the point that talking about transparency and members having a level of awareness and education to who are their pension fund trustees. I'd also like to implore our viewers to look at, are there any conflicts of interest between your advisor and your pension fund? So if you're if you're in an insured pension fund, typically a large umbrella fund, and the advisor serving you is also employed by the very same company, there's an inherent conflict of interest. You cannot get independent advice in the absence of you, having that level of transparency, working with your retirement partner as well as your advisory partner. The second point that I want to highlight is that, pension funds are really here, to promote the financial well-being of our members. I don't believe pension funds are doing enough to drive financial education and literacy. It's one of the primary reasons why the regulator has introduced retirement benefit consulting. There's a greater emphasis on financial literacy now than ever before. And I'd like to ask my insurance partners to join us in the effort of driving education and advice, and doing so very transparently with our mutual customers and disclosing those conflicts of interest that exist. The challenge that we have, Joanne, going back to 2007, the independent advisory market represented some roughly 65 to 70% of the financial advisors in the country. Fast forward 13 or 14 years, independent advisors barely make up 16% of the advisory market. Now that does not help the South African consumer. And so we have a responsibility as an industry to protect the independent financial advisor. And more so, I would call on our insurance partners to disclose those conflicts of interest and ask our viewers to ask their advisors to disclose those conflicts of interest, especially where they're employed by an insurance company, because certainly the advice that's being delivered is not with the highest standard of integrity or, for that matter, free of any conflict of interest.
So we've got some very interesting questions coming in at this point, and I want to take some of these questions from our panel. Some of them are comments as well, but perhaps our panel would like to weigh in on them. I'm going to start with this comment from Tebogo Majela, who says politicians should not be allowed to make decisions on money belonging to the public servants, nor should unions decide on behalf of employees. Some unions have a political bias over their members. A seat at the PIC table should not constitute permission to take decisions on behalf of their members. Employees must be allowed to vote on whether their money must be thrown into SOEs. We've seen through state capture revelations how corruptly appointed persons facilitated corruption on behalf of politicians in SOEs. Employees must be independent of their unions and take government, including their unions, to court should they want to invest their money in pits. Andrew, what's your take on that?
So that is an interesting one. I mean, in general, as I said earlier, the trustees of a fund are the investment. They set the investment strategy. But importantly, remember, they are a fiduciary. They need to be doing that decision-making with the interests of the beneficiaries, which are the members of the fund, at heart. But just to the point that seems to be raised in the question is the PIC looks after the assets of the GEPF, which is the Government Employees Fund. And actually that is a slightly different situation because it is a defined benefit fund. So in other words, the members are not the ones carrying the investment risk and the risk of underperformance of any investment strategy. So actually, the taxpayers are the ones that are ultimately going to have to fund any deficit in that fund as a result of poor investment decisions. It is different in a defined contribution fund, which the majority of workers in the private sector are part of in terms of their retirement funding. That's where you as the member carry investment risk and any risk of underperformance related to the investment strategy. So there, I do agree, it's important for the members to be able to make or have some influence on the trustee decisions. And that's why often in those funds, there is actually member choice of a number of different strategies that the member can choose for their personal retirement savings.
Andrew, thank you for that. Clem, let me bring you back in here because we've got a comment from Portia who says this would be a very bad move if implemented. And I must just scroll up once again here because I've just lost that message from Portia. But essentially the crux of what Portia is saying to us is that people have worked hard over decades to be able to save this money, and that if it ends up in the wrong hands or if it is invested in an SOE, for example, where it does not bear fruit, that workers essentially end up with nothing to show after all their years of hard work. Clem, do South Africans have a moral or patriotic duty to agree that their pension funds be invested in the country's state-owned enterprises? And perhaps just to expand on that and to clarify, that is if there were either the kind of investment merits that Varesh has been talking about, or if there were much stricter financial controls.
Yeah, my view is that it all comes down to how well those companies are managed. It is absolutely not possible to put pensioners' money into something that is going to be a disaster. And I'd like to just give you the broad background to that comment. I don't think life for defined contribution pensions has been tougher than it is at the moment. I just give one statistic, which was that at the end of 1999, the FTSE 100 was over 6,900. It was 6,950 or something like that. It's now 6,300. So in 20 years, the UK stock market has fallen. Yes, people have got the benefit of the dividends from those companies, but I can tell you from talking to a lot of British investors, never has life been so tough. And here in South Africa, we've had 5 very flat years in terms of investment. And so we're in the toughest game of all. And I pay tribute to my panel partners who look very fit and well on this, because actually it is a tough game. So to actually say now you've got to invest in companies that at the moment are failing is just out of sight. And yes, I want things to turn around to the point that we are using retirement money to build a new South Africa and to get rid of economic apartheid and do all the right things. But it is not by investing in companies that at the moment have not shown any type of good performance at all.
So here's an interesting one, Anthony, from Alistair Campbell, who says a point worth considering is that the call for prescribed assets is one which is to force pension and provident funds to invest in infrastructure. This doesn't have to be state-owned. It can be privately owned and structured as a PPP basis. In this way, the money can be channeled into infrastructure in a responsible manner instead of simply providing a handout to a poorly run SOE. What are the possibilities there?
I think it's a great comment and suggestion, Alistair. and I'd like to maybe backtrack a step, Jan, and just to highlight that South African pension funds already invest in state infrastructure and development plans through government bonds. Pension funds are invested in government bonds, and therefore, through the process of investing in these government bonds, those monies are used for infrastructure development. I think it's a great idea to use the preferential procurement process to partner and drive some part of the infrastructure expansion in the country, and it doesn't necessarily have to be centered around a government initiative. I think there could absolutely be a public-private partnership initiative that could drive that. But the fundamentals that we would have to consider is track record, sustainability, stability, and very importantly, is this a feasible investment? And I think to simplify for our viewers, the argument that needs to be addressed in every one of these investment decisions is we have money that needs to be invested. Are we investing it in the right asset? And if we are talking about sustainable and well-run state-owned institutions like a Transnet, great. But if we are not, if it's another state-owned institution, if we are talking about the likes of an Eskom, who arguably is overweighted in terms of its human capital, then maybe it's a good idea, Jan, that we get the Eskom employees to invest their own pension fund into Eskom so they can hold their leaders accountable, for their decisions. Maybe that might be a good idea for us.
Clem, a bit of an ideological question here from Matt Brensel, who says, how do you persuade a government that believes it is solely responsible for economic growth that the development of SMMEs via private equity capital injections is the better option?
Well, I live in the world of facts, and if you look at the countries that have really succeeded economically in the world, it's because they have built up this incredible new wave of entrepreneurs. I did a session with the Chinese Communist Party in Beijing in 2006 and was shown around the Central Party School, which is where all the senior leaders are educated. I was only one of very few Westerners allowed in the school. And what came out was that all the slogans of Mao Zedong had been taken down and replaced by slogans of Deng Xiaoping. And when I asked one of the professors why, he said, Deng said two things. We must put a huge emphasis on infrastructure, which we've been talking about. And he said, secondly, we put a huge emphasis on allowing individual Chinese entrepreneurs to create their own wealth. They were the 100th ranked economy in the world when he came in 1978. They're now number 2 and probably going to be the number 1 economy in the world by 2050. So that's why you do this, is you want South Africa to become a great nation. The government is there for law and order, for health, for education, for defense. There's lots of very important things that governments do. But the real crunch is producing this new generation of entrepreneurs.
I'm going to move away from the prescribed assets conversation now and largely what we've spoken about and just start wrapping up with the issue of other areas that impact retirement planning at this point, just for the benefit of listeners or viewers who would want to just have a bit of an insight into certain issues affecting their own retirement. And I'm going to ask you all for very brief answers on these questions, please. Anthony, starting with you. Should brokers that work on medical aids and brokers that work on retirement planning collaborate more closely so clients receive a more comprehensive, tailored solution that responds to all their financial and health needs?
Absolutely, without question, Joanne. I think the overarching benefit of integrating the advisory process where you could deal with a client's healthcare needs and retirement needs is so intertwined. And so the employee benefits and the insurance needs of clients will continue to be what we define as a very high advice sector and need for the South African customer. And brokers should absolutely collaborate. And I think customers should look for brokers and financial advisors that house a holistic set of skills that can advise all of their financial needs.
Andrew, is it ever too early or too late to start planning for your retirement?
No, I mean, obviously, first of all, it's never too early, because the reality is that even though you might think you've got a long time, over 40 years, say, when you're in your 20s, to build up retirement capital, that because of the fact that you need to save 15% or more of your salary and still get a return of CPI plus 5 from your investment strategy after fees, that's quite onerous. So you really need to get going and make sure that you give yourself time for investment returns to actually do a big part of the work and not your little contribution out of your salary every month. So that's the on the too early part. And the too late part is just as important. In other words, just because you haven't done it and you haven't got that early start, don't give up. I mean, that is so important. Still get involved and do what you can. And the other benefit is that if you're in your 50s or even early 60s, often you do have more disposable income at that time, because your kids are off your hands, your house is maybe paid off. If you're lucky, I'm talking about these sorts of things, not always the case. But you can save 27.5%, which is the maximum that you can get a tax deduction on, % of your salary. And so you can play quite a good catch-up game even at that late stage.
Varesh, many people are wondering how relevant retirement planning still is in South Africa. Is it wiser, for example, to invest in products that will serve you now, like property, instead of a retirement annuity?
This obviously depends on your own personal circumstance, and that's where high-quality financial advice makes a meaningful difference. But on the generalized level, retirement funds still provide the most tax-efficient vehicle available for individuals to fund and plan for retirement, and that can be quantified quite clearly. In the concept of employer occupational retirement funds, we must also bear in mind that they allow for a significant degree of financial inclusivity, given that the majority of employees in the typical employee base simply would not have access to retirement annuities or life insurance were it not through these compulsory schemes instituted by their employers. So retirement funds play a key social role in providing financial inclusivity in and across the country.
And Clem, a final question to you. I think one knows from this discussion and from just general knowledge that retirement isn't just about one's own personal circumstances. It's also about the context into which you will be retiring when that moment comes. Is it possible to determine that future environment by the way you choose to invest as an individual or a group right now?
Look, my advice for all people who are putting money aside is that in today's uncertain world, you've got to be diversified, and it is crucial not to put all your money into gold or put all your money into stocks. And that's why, to be honest, I think the professional retirement industry in South Africa is as high quality as anything else in the world. It's a pocket of excellence that we have here, and as was correctly stated, the legislation is unbelievably well thought through. So we do not want to destroy the jewel in the crown at the moment, and I certainly feel that, as I said, we're going through hard times at the moment in terms of investment compared to the last century. And the only strategy at the moment to try and get through your life in retirement is to be diversified. Don't bet on single asset classes. I had a statement from somebody in London recently who said we're now dealing with an equation where old people are tossing up poverty or death. I mean, they put it as bluntly as that because of the fact that people are not putting aside enough for retirement. So it's a huge challenge, and I just don't want it complicated further by things like prescribed assets. We're in a very tough game.
Thank you so much for that, Clem. Anthony, I'm going to wrap it up with you because we're coming to the end of our discussion now. Do you see this pension fund issue as an issue that will effect change? Are we at a crossroads where we decide, okay, let's carry on along the same trajectory we always have, or let's take a slightly different route that may have a material effect on whether our economy grows, our tax base widens, among many other issues?
Jan, let me say from an ASI perspective that we would certainly not support any decision that undermines the pension fund value and replacement value of funds for our clients, and certainly any policy or decision made by government would not be supported by us if it doesn't ultimately protect the pension fund member. I think any change that is introduced that supports pension fund growth, we will certainly be in support of. I think there's a lot of positives that we can draw from the discussion around prescribed assets, and that is certainly the intention of government to create employment, to provide an economic stimulus and develop infrastructure, and that's certainly a positive for us. But I think the message that I want to leave South Africans with is we need to ask ourselves the question, what is the end game for us? What kind of country do we want to retire in? And more importantly, if we are to build the trust bank in South Africa, yes, we know that government needs to play a bigger part in that, but what are we doing as South Africans to invest in that trust bank? And certainly we can't follow conventional wisdom to change the state of our country.
Anthony, thank you so much for your insights there. Thank you for helping us to unpack these complex issues, and thanks to ASI for their partnership, which made this discussion possible. My gratitude especially to our panel for sharing their insights today. Thank you very much, Viresh, Andrew, Clem. Really lovely having a chat to you, and a special thank you to all the viewers who joined us this morning. A link to the recorded session and further information from this discussion will be included in the thank you mailer, which will be sent out after the event. So please keep an eye out for that. It's been a pleasure being with you this morning. From me, Joanne Joseph, goodbye and take care.